Hello and welcome to this special edition of Echo45 Advisors Market and Economic Update. In this video, we'll cover major trade progress between the United States and China and what it means for investors. The US and China recently announced a trade agreement that reverses many of the tariffs that disrupted markets in April. This 90-day agreement reduces US tariffs on Chinese imports from 145% to 30%, while China has lowered its rates on US goods to 10%. The administration has also secured tariff pauses with several other trading partners and finalized a new trade deal with the UK. These developments have eased concerns about a prolonged trade war that previously led to market volatility. It's worth noting how markets have responded to these developments. What markets consistently dislike most is uncertainty and negative surprises. When the April 2nd tariffs were announced, markets priced in the worst-case scenarios almost immediately. However, as clarity has emerged around trade policy, we've witnessed a remarkable recovery. Over the next few minutes, we'll discuss how investors can keep this announcement and other trade news in perspective. First, this chart shows the latest reciprocal tariff rates alongside those initially announced on April 2nd. The US-China trade agreement marks a significant step toward reducing tensions between the world's two largest economies and potentially paves the way for a more comprehensive trade deal. Looking back, we can see parallels to the trade negotiation during President Trump's first term in 2018 and 2019. In both cases, the administration used tariffs as leverage to secure new trade agreements with the stated goal of addressing trade imbalances. What distinguishes today's approach is the administration's more aggressive initial tariff positions than many analysts had anticipated. However, the recently announced US-UK trade deal, which establishes a 10% baseline tariff with special allowances for vehicle imports and certain exemptions, suggests a similar pattern of negotiation leading to workable agreements. Next, despite ongoing trade uncertainties, the American economy continues to demonstrate remarkable resilience. While new trade agreements with China and other global partners are still in progress, the markets have shown they can weather this uncertainty. For example, this chart shows that the economy shrank slightly in the first quarter of the year. This is because businesses stockpiled imports ahead of potential tariff deadlines. It's easy to see that while consumer spending slowed, it was still positive. As clarity emerges, this will likely be positive for both businesses and consumers. This is in addition to other positive economic news in recent weeks, such as a strong jobs report and improving inflation. Finally, as this chart shows, recoveries from stock market correction often occur when they are least expected. When markets are volatile, it can be difficult to see light at the end of the tunnel. Yet history shows that recoveries often arise when investor sentiment is at its lowest. The resilience we've seen in markets over the past several months demonstrates how quickly narratives can shift. While trade policies have created uncertainty, investors who maintained their long-term positioning have generally benefited from market rebounds. While understanding market risks is important, overreacting to volatility can leave investors poorly positioned for recovery. We hope you found these insights helpful. If you would like to discuss tariffs, markets, or your financial plan in any more detail, please don't hesitate to reach out. We look forward to speaking with you.